I'm Georgia Williams with the Investing News Network, and joining me today is John Kaiser of Kaiser Research. We're here at PDAC 2020. Good afternoon, John.
Georgia, it's a pleasure to be on Investing News Network.
Thank you so much for joining us today. Now, I had a bunch of prepared questions for us, and then earlier today, the American Federal Reserve decided to cut interest rates. So I had to throw all of those questions out, and I thought that we would talk about that instead.
Okay.
So do you want to tell us a little bit about your thoughts on the interest rate cut that was announced earlier today?
Well, last week was a horrible week for the equity markets, which rippled down into the resource sector in the June years. And of course, the reason is the realization that the Chinese response to the coronavirus, which was too late and then voracious, has created a major disruption in the Chinese economy, which is still part of the global supply chain. And things are not arriving in the shelves anymore. Amazon's shelves are getting empty. This is a problem that's rippling through the economy, and the market was reacting negatively because they can see, oh, the bottom line is going to be negatively impacted, and so it sold off, and it was overpriced anyways. It could go, Dow could go back to 20,000, be a 30% haircut, but it's not the kind of catastrophic event as 2008 when it was about the collapse of the entire financial system that hurt 100% of people.
Right.
This is a haircut for the 1% hair that will grow back once this is stabilized. Now, the worrisome situation now is it's wild in the United States. It's replicating. It has a high transmission rate, 2 to 3, and there's no longer an obvious contact. This person wasn't in China or in contact with the Chinese person, so we don't know who has it. So it's going to spread throughout the United States and the world, and there is a mortality rate right now, 2%, that has people freaked out. So now the concern is, what is the American response going to be to this? Will it be as disruptive as the Chinese response? So this half-point cut was a preemptive cut to sort of ease the fears about this, but I think it's not going to be a very effective one. How many more of these they have left? Not very much. We're going to be at 0% interest rates, and then what? That hurts all the savers, the retirees who are now getting zero on their savings. So I don't think this is the solution to the problem that we're facing with.
And in terms of gold, how is this going to impact the gold price?
Well, gold yields nothing, and that's the knock against it. But if your bonds are yielding nothing, well, gold is suddenly becomes interesting. If your bonds go negative, as they are in Europe, well, then you're better off owning gold. Now, the bonds will always be redeemed in the nominal value of the currency, whereas gold is priced in currency and what can be up or down. I think we're heading into a major repricing of gold into the $2,000 to $3,000 range, which is now, I'm even stronger believer in this with the uncertainty that this coronavirus is injecting into where on earth is the world going. So lower yields are good for gold.
Right. And for the rest of the precious metals?
Well, this is the problem, because uncertainty is not a good thing for raw material demand. It was turning in January, everyone was getting quite enthusiastic about the juniors because people were starting to accept that gold was in an uptrend. It was kind of puzzling how in 2019 there was no follow-through response. And gold now isn't going up because of inflation concerns. It's going up as a safe haven hedge against uncertainty. Now, there may be a silver lining to this crisis that we're facing, because the trade war was tipping the global economy over the edge into a downturn, and now we have this unexpected coronavirus making this potentially worse. So if things get really worse, well, you could expect metal prices to go lower, but then you start having political implications, and one of the major responses that the United States could have is that of keeping a promise Trump made that he hasn't really addressed, which is infrastructure renewal. So fiscal spending, which has always been shunned by Republicans and all the fiscal scolds, this is now a potential reality, and it would immediately create jobs. It would create the debt go up, but it would be debt that's yielding whose interest cost is zero.
Right.
So why not do this? It would get rid of this end times mentality that's seeping into the system. I mean, stock market's up because when the corporations got their tax windfall, they didn't see a vision of what was going to keep America getting greater and greater. It was just this, oh, America is no longer great, and we got to think about making great, but what are we doing about that? And so the money all went into just the stock market, propping it up, not into the ground, as one would say, in the mining industry. And with infrastructure renewal, it sends a signal to business that America needs to be made greater in terms of its aging infrastructure. It's something for the younger generations, the post-boomers, who will be paying for this long after us boomers have ridden off into the sunset. So it gets them out of this end times funk that they have been starting to descend into, and it could actually rally the American people who are getting angrier and angrier with each other over this polarization. And if this is brought in like almost like a context of, it's like a war response. The enemy is this coronavirus and our fear of it and the economic downturn that come. We're going to renew America. We're going to spend. Raw material demand's going to go up. The rest of the world is going to see this happening. They will be inspired. This whole deglobalization process that was underway, it will probably stall, and we could get the global economy back on track. And this could get Trump reelected, and with having done something that both sides of the political spectrum say this is actually good, because if the Democrats get in, they will have to do something like this also.
Right. And you had briefly mentioned some of the other commodities that are being impacted. And, will we see copper do well this year? Is it going to correct itself? Or how can we expect to see some of the other base metals moving forward?
Well, all these metals like nickel and copper have long-term supply-demand imbalances in the cards, but this is assuming a global economy continuing to grow.
Right.
So the big unknown is, will they blow it and allow the world to descend into a major economic downturn, in which case the demand is going to go down, the supply is going to be still pushing at it,
right.
And that's of course not going to be good. But if we weather this, if the response gets ratcheted up so that it becomes just another flu that affects a lot of people, and they have a way of catching those who are most vulnerable, and there is a particular demographic that is much more vulnerable than 2%. 2% is just an average. If they can contain this and the fear that a younger person who gets it, well, it's just a nasty flu, but if I go visit grandma, that could be the end of her. This is the thing that's so frightening about this, is the selectivity of this virus. If we get through this, and it will be like fall before we really know, then I think the metals will all trend up, especially if radical steps like infrastructure renewal have been undertaken. But if it's still going crazy and out of control, and they're just lowering the interest rates, and there's nothing fundamental being done, it's bad news for all the raw materials, except in terms of supply disruption, because this means China's problem is also getting worse, and a lot of stuff comes from China. So you will have shortages of metals, so you'll actually see the prices go up. But it's not for a good reason. It's because suddenly there's nothing available.
Right, and you had mentioned that you see gold going to 3,000. Is that by the end of the year, or is that the price high for the year?
Well, based on the 6 billion or so ounces that exist, $3,000 would mean that all the gold that exists is equivalent to 26% of global GDP, which is what $850 in 1980 was relative to the GDP at that time. That was a period of enormous stress and uncertainty. I think we cannot easily escape this stress, this uncertainty about where the future is going. The future is now up in the air. It's actually fun to sit down and speculate about all the forks in the road that the future can go. Like most of my life, the status quo was pretty much there, and there might be little random perturbations, but basically everything was moving on. Now anything is possible. Even something wild like this coronavirus in China, stirring up an insurrection that topples the Communist Party, which to protect against, because they basically blew it, so they're responsible, everybody knows it, they deal with it by annexing China right away to create a diversion so that it's all about this other side, which puts America up in arms, especially since the semiconductor industry is still based there and an important part of the American technology supply chain, and endless knock-on effects that all of this can create. Even the lower oil price endangers America's self-sufficiency because shale oil fracking doesn't work at $50 oil or below. So how to solve that problem? Let the Middle East go up in flames, and all of a sudden you have Saudi Arabia and Iran offline, and oil is $100 and American oil production is there. So we have now an environment where leaders are not thinking as a global team anymore. It's everybody for themselves, and in this type of context, almost anything is possible.
And a piece of advice for investors to weather this storm, but also prepare for the future?
Well, I think, gold ownership is a safe haven. Try to resist all this kind of histrionic stuff I'm waving my arm about, but do recognize that, gold going to 2,000, 3,000, that's a good thing if everything ends up stabilizing and getting back to normal. But appreciate that a move of this nature without inflation as part of it has huge implications for existing ounces in the ground and for what counts as the bar for what counts as an exploration discovery. So that becomes the rationale for new money coming into a space that's been in the doghouse for 10 years. So I think this is an opportunity. The pullbacks we've seen in the companies, it's temporary. Only half the companies were affected. The ones that weren't affected have negative working capital of $2 billion. They didn't go down because they're already down and out. They're zombies going nowhere. The other ones that were starting to ascend because they have stories going, they have money, they've had a temporary setback. We may get more because the volatility in the senior market is not over yet, but this isn't a buying opportunity. It looks and feels like falling knives and anvils as it did in 2008, where it was very painful to buy on the dips, but it's not the same as, say, buying Amazon and things, which are all priced for the best case scenario. The resource juniors are still priced for the worst case scenario. So when you get that cheaper at that valuation, that's a buying opportunity.
And I think we'll leave it right there.
All right, thank you.
Thank you very much, John. I'm Georgia Williams with the Investing News Network.